Hey guys, on today's episode, we're going to do a deep dive into data. We're going to talk about jobs, inflation, interest rates, and what that means for you as a buyer. Hi guys, it's Michael Soldano with the Amanda Bang team. I have a very special guest with us. Her name is Patty Goodspeed. She is a mortgage expert, and she's going to give us some information and insight on what's going on with the market now in terms of inflation, in terms of jobs, in terms of mortgage rates, and what that means for you as a buyer or even a seller, and where we're headed down in the next 6 months to a year. Patty, do you want to go ahead and tell us a little bit about yourself, and then we'll get into the topic.
Absolutely. So my name is Patty Goodspeed. I've been a mortgage banker for 20 years. I'm one of the top 100 female originators in the country and top 1% overall. I'm an investor myself, so I care deeply about what's happening with real estate. I'm also an educator. I host a free webinar once a month to be able to unlock the truth behind the headlines out there, because many people are really kind of suffering from the gloom and doom of the headlines. So I'm excited to be here today. Thank you for having me.
Awesome. So maybe that would be a great place to start, the headlines. We've been hearing interest rates are high, they are high. But what's happening? I actually was just hearing interest rates were supposed to go up, but then I checked them and it looks like they actually went down a little bit. Maybe can you fill us in on what happened or what's kind of going on?
Sure. So the United States leads the world in this aggressive federal rate hike trend that we've been seeing. And it threatens the global economy, and many fear that we're headed towards a pretty significant global recession. And why that really matters is because it's not like the United States functions independently. We trade lots of goods and services with other countries. And so what happens to the US dollar might really truly impact how countries like Europe and China interact with the United States, and that impacts everything in our households, things that we overlook and that we don't understand. So when we look at real estate, we're often really just worried about, oh my gosh, I can't afford to buy, oh, the rates are too high, the home prices are changing, but it's actually a global issue that we're talking about when we're talking about inflation. So recently, with the Fed meeting, what we were looking for from the most recent Fed meeting was that we wanted to hear them pivot. So if you are listening to this call and you have paid attention to the news and you are reading a lot of the commentary on the Federal Reserve's monetary policy, then you understand that we are looking for the Feds to start pivoting. Pivoting from what? Well, they've been consistently raising the Fed funds rate by 75 basis points over and over and over again. This impacts the monetary policy, not mortgage rates. So what does that mean? That means that the money supply, the money that the banks are borrowing from each other to circulate in the economy, is exactly what is impacted by the Fed hike immediately, okay? So what does that mean? It means that, hey, this company that had access to a lot of money to go create new jobs and to invest in innovation and creates new branches of their corporation to generate more revenue is now saying, wait a minute, I've got to cut some expenses because I can't keep up and I don't have the same access to money. So essentially, the Federal Reserve wants to disrupt demand and create what's called price stabilization. If you have a certain amount of goods and services available, and you have more people than you have products, more people that want to buy them than you have products available, of course it's going to drive the price up. And the price of those goods and services have raised way too quickly. So now the Fed has to be extremely aggressive in their policies to continue to hike rates to bring inflation down. That's the overall aspect, that's the overall summary of what's happening. So in the last Fed meeting, what we were hoping for was the Feds to send a clear message that they were no longer going to raise by 75 basis points, but that they would pivot to 50 basis points or 25 basis points. And because what they're doing is so aggressive, they haven't let enough time pass to see the impact of it and this lagging report. So in November, when they made that statement, the markets reacted negatively. Interest rates went up because they gave no indication that they were going to pivot. But what they did say that I feel most of these people overlooked was that they were going to make changes based on new data that becomes available in between meetings, which leads us to last Friday's CPI report. When the CPI report came out, the beauty of it was that it came in much lower than expected. We were expecting a CPI at 8% and it came in at 7.7. Core inflation was expected at 6.5 and it came in at 6.3. Despite the slight overall increase in inflation, the numbers came in much lower than expected, which finally sent the message to the markets that the impact of the Fed's decisions are working. This is a small indicator. So the bond market performed well. Bonds jumped as much as 170 basis points and interest rates came down. The bond market is directly correlated to how your mortgage rate sheet moves up and down every day. So what essentially we're looking for is a reduction in inflation, which also leads to more layoffs and less jobs being available. And as a result of that, we're going to see mortgage rates go down.
That's awesome. I feel like for the past almost 6 months, we've been hearing rising interest rates to fight inflation, and it just keeps going up and up and up. And it's nice to hear that there's finally at least a sign that, we're actually making some progress. I guess from a consumer standpoint, at first it was like, what's happening with inflation? And now people are noticing, oh, it is a little more expensive. But I'm actually really glad to hear that there is, that we're able to kind of, come in below that metric for the CPI, and then that with an indication that the raising of rates is helping.
Yeah, it is. It's great. Yeah, that's exactly what we think it is. I saw someone tweet jokingly, oh, look, the real estate industry is just so excited rates drop. No, I don't think we're excited that rates drop. What we're excited is that this is an indication that the Fed is going to change their tune. And as a result, we can slowly see rates improving over the next 3 to 4 months, taking us into a spring or summer with interest rates in the low 5% range, which would be phenomenal for home buyers. What will happen is, though, the conversation is going to shift from rates impacting payments to people asking us, people like you and me they're going to ask us, hey, when's the price going to bottom? These prices are going down. When is that going to stop? When's that bleeding going to stop? And we're, again, not going to have the answer to that because the market is doing what the market does and it's correcting itself. So again, the best time to buy is when you're buying within your own means, and make sure that your real estate purchase is long-term and not short-term, and you will win when executing in this economy.
I totally agree. I know it's interesting to think that actually, even with interest rates high right now, in some ways it's discouraging a lot of buyers, so there's less competition. And one thing I'm almost afraid of is that when we come back down to that 5% range, competition is going to go up, and actually it's going to turn back. The Bay Area right now, it's actually a fairly balanced buyers and sellers market, if you look at it from kind of a high level view. And even though, it's nice to have a market that's very vibrant and there's a lot of movement, but I'm almost afraid that at 5%, we're going to go back to that 5 to 10 offers on a house, and it's going to be, 7 days on market or less. But maybe can you tell us a little bit about some of the other metrics that are involved? Like how do jobs and unemployment play into this?
Well, so they say that wages are not inflationary, and what that essentially means is for job reports, what you're looking at is how much people are getting paid and how much time they're taking off work, or whether or not they're looking for other jobs. So in a very heated environment, which what we had prior to what's happening now, you would see that, let's say that you and I both worked at Facebook and we had 2 years at Facebook. Now we both have experience as software engineers or product managers. And we're like, wait a minute, Amazon's willing to give me 30% more and their bonus structure is better and they're going to pay me more RSUs. I might go take this job at Amazon. So you're job hopping. So you went from Facebook to Amazon, and then you said, wow, with 5 years of experience, Google's willing to give me a $100,000 sign-on bonus with another 25% raise in my base pay, and their RSU structure is even better. I'm going to go to YouTube. So you do this thing called job hopping, right? And so that is, they do measure that. So now you have more people that are, wait a minute, I better stay here because now the tech companies are laying people off. I better keep my job and I've got to stay here because less new job openings are all available. And as a result of less new job openings becoming available, that means that I better stay where I'm at and hope that I can keep my job and I'm not on the chopping block when layoffs come. Okay. In 2018, 2017, the Federal Reserve had taken their rates up to 5, but because it slowed down the economy so quickly, they immediately switched gears. Why? Because the job market was certainly not as healthy as it is today. We are in an environment right now where the Fed is continuing to aggressively hike rates because we have a strong job economy. Anything between 3 and 5% is a really healthy job market. So right now we have the unemployment rate at about 3.7%. The Fed wants to see that go to 4.4%. Again, I think that some people will say, why would the Federal Reserve want people to lose their jobs? It's not that. It's that the rate at which these companies make new jobs available or promote people or keep them longer, whatever that is an indicator that they're spending money and doing well. We need people to stop spending money to reduce inflation. It's spending that becomes a problem. So then if the company is doing well and they're offering new jobs, then guess what? The prices are going to keep going up because people have the money and it's circulating. So actually unemployment is an indication that tightening the money supply is working and that fewer jobs are becoming available and that things can slow down just a little bit. Because again, what we were seeing with inflation was unsustainable. So it's a painful reality of what has to happen in this course correction.
Very interesting. Yeah, I remember just a couple of years ago, I think around 2018, where I was reading in the news, unemployment was really high. And I'm glad that you brought it up, that we're actually in a good place right now where, unemployment's relatively low. And that should, even though there's a lot of things kind of going on, a lot of layoffs that we've been hearing about lately, I know in the big picture, having that unemployment number fairly low is an indicator of long-term strength, and that, hopefully we'll be in a better place 6 to 12 months from now.
I think so too.
That's
good.
And
we want stability. So if unemployment goes even up to 5%, then that's still healthy. That's still a sign that it's not out of balance, and that's what we want to see. We want to see less job new openings. We want to see people spending a little less money.
Right on. I can agree with that too. Maybe can you tell us, so how does the stock market kind of fit into all of this? I know we've been on kind of a pretty strong run for the past couple years, but then recently I know there's also been a little more turmoil there, but how does that kind of play into things?
Well, directly involving the real estate market, and especially the markets that we serve, most of the people who are buying properties were liquidating from their stock accounts, right? So I'm going to take my money out of the stock because housing is performing better. So on an average of even in stocks, you could say there are people that would argue they were making 15% returns, which again is unrealistic. So at the height of those returns, I'm going to liquidate and put it in housing because I need to diversify and keep stability. Well, if the value of my stock went from $100,000 to $30,000, I'm less inclined to take money out at a losing position. So even I checked my Tesla stocks this morning, they were low, and I'm like, okay, well, I'm not going to liquidate that to go invest in something else. Why would I sell at a loss? So many people are really holding on. So I think the stock market overall, when we're looking at it, the stock market is impacted just like housing by the monetary policy, because companies, when you're buying a stock, you're buying a portion of a company, right? That's publicly available. Well, if these companies come up less, there's less stock to buy, there's less people to invest in, that creates a lot of volatility, and the value of existing companies are going down. So that essentially affects you and I's ability to go liquidate stock to go buy a house. So it creates lack of liquidity in the housing market, right? You have less people that are willing to liquidate to go out and buy. Even the value of their 401ks might be down. So I'm less willing to take a $50,000 loan against my 401k to buy a house when I know that the value of my asset is going down and I'm relying on that for retirement. So the stock market plays a major role because many people rely on those funds to liquidate to buy housing. And if a significant part of your net worth is reduced as a result of what's happening in the economy, you're less confident in going out and making large purchases.
Right on. Yeah, it's interesting you kind of brought that up. Thinking about some of the clients that we work with, there's definitely a large number of them that would sell RSUs or sell a portion of their stock portfolio to fund the down payment, almost like, moving, your eggs from one basket to another. But I can agree where the market is, people are a little more careful about that. And I think that in some ways is almost a good thing. I think sometimes we have too many buyers and that competition is too high in the Bay Area. And we kind of touched on this before, even though interest rates are a little bit high right now, admittedly, because that's reducing buyer demand, actually, it's putting a lot of power in the buyer's hands. And it's our broker was bringing up this statement, real estate is on sale right now. We're about maybe 5 or 10% below our peak prices this year. There's less, there's also less competition, goes hand in hand. And I know, just like we're saying, there's a lot of turmoil going on, but what would you say? Do you think now is a good time to buy a house?
I think the best time to buy a house is when you're buying within your means. I think that if you're worried that the market is going to shift by another 10% in 2023, then you wait for a property that's been sitting on the market for 20 days with no offers and make a killer offer on it. If you want to preserve money and you want to shop smart, then you're not going to buy the house that goes on the market right now with a facelift on the kitchen, with a brand new paint job and a manicured lawn, right? You're going to buy the property that sat there for 21 days that no one's placing offers on, and then you're going to go in aggressively and ask for credits and a price reduction. So if you're buying in a way that you can afford, it's always a good time to buy if you have the right mindset. So if you think that if the prices are going to continue to go down, you might sit on the sidelines a little too long and get back in the game just as soon as they start picking up again. You can't time the market. You just can't do it. If we could time the market, then we would be multi-billionaires and we would not be sitting here having a YouTube, recording on a weekend. We would be golfing, okay? We'd be on vacation. I would be in Lake Como. So we can't time the market. If you're trying to call the market and you're trying to time the market, it's a losing battle. You have to know your numbers and you have to understand what you can afford. And the strategy to lowballing comes with properties that have been sitting on the market for 20 or more days with no activity, not the property that just hit the market, freshly manicured and staged to sell.
Right on. Yeah, you kind of highlighted something, it's interesting, now that things have slowed down a little bit on the, in terms of buyers, there are quite a few properties that are sitting on the market. And I remember even just as recent as like January, February of this year, houses that were all dressed up and ready to go, they would sell in 7 days or less. And now, 14 to 28 days is actually pretty typical in some areas. And I think it's definitely a healthier market to see that going on right now, where you've got enough time to look at the house, to make your decision, to make sure that you're fully committed to it, and you don't have to kind of compete with 10 other people, put your bid in within 24 hours of seeing the house, and maybe you've only seen it once. I feel like it actually gives a lot of power to buyers and a lot of confidence too, where you can go back to the house a couple times, maybe there's a couple more houses that you can look at, there's a little more inventory. So I think, but then like you said, always kind of think about your means and your limits and think about if now is the right time or not, not something that you want to rush, but I would say, if anything, there's a little bit of opportunity.
Perfect. I agree.
Good. Do you have any final words? Are there any other things like that you would recommend for buyers to pay attention to if they were thinking about buying a house in the next 6 months?
I think the buyers need to just be able to dissect the truth between the headlines. And I host a free webinar you can access it through my Instagram. My handle is right there on the screen. And why it's important, it's completely free. It's a place to gather and answer questions just like this so that we can talk about what's happening in real time. There's going to be a lot of news from the feds between now and January that'll have a huge impact on rates and as a result, a huge impact on home prices. So let's pay attention to that. The key things to focus on is going to be food, energy, and housing, and that includes, of course, gas prices. It also includes, jobs. So you want to make sure that that's a fourth category, but you have the jobs, the foods, energy, and housing. Pay attention to the stats that are coming out with that, and don't ever forget that it's hyper local. So something you hear on the national news may not apply to where you're trying to buy. A local expert like Michael would be the perfect to collaborate with and say, what's the data within a 1 mile radius of the home and the neighborhood that I want to buy in? That's the key thing to do. Focus on what's happening locally, and then you should be set up for success.
Right on. I appreciate that. I'm really glad that we were able to get you on this call today. I'm very happy about all the information you shared. A lot of our audience they're very data driven, I guess so are we. So I'm glad that we can kind of show them about what's going on under the hoods, because, like you said, it's easy to kind of fall into the trap of headlines and to see what's on the front page of the news, but to really understand what's actually happening and to that will hopefully give our audience a perspective on where things are going and help them make the right decision for their next real estate moves.
I
Great.
agree.
Well, thank you so much for your time, Patty. I'm very glad that you were able to join us today. Until next time, this is Michael Saldana with the Amanda Vang team, Patty Goodspeed. Our contact information, we'll add that below, so don't hesitate to reach out, set an appointment, talk with us, and until next time, see you guys later. Bye.